All right. One of the things we do here now is this retirement series, and they said, just who of our anchors would be good on retirement issues? Who might be more seasoned to address these kind of issues and talk about interest rates backing up and the kind of sometimes less than riveting issues that could really maybe fixate the nation? What's Cavuto doing? Here I am. You're welcome, America. What we're taking a look at, and this should be fun, because every week we're going to look into the kind of issues that could affect you, either think about retirement or those of you on the verge of retirement, or those surrounded by people you work with who are urging you to retire, which is, what are you laughing at? Yeah, it was a joke. And with me right now, my buddy from Barron's, Jack Otter. You know, Jack, and I didn't realize this, he wrote a great book a few years ago. It was right after what was one of the worst decades for the stock market. Worth it, not worth it. It takes a look at principles on investing and planning for college and all of this, the pros and the cons, what you can do. And it's so well written. It's very, very clear. I read it in the morning. It was good stuff. So who better to help me navigate these retirement waters? He's a lot younger than I. Very good to see you, my friend.
Good to be here. I'm so glad that on the less than riveting subject, if you're the anchor, I'm the guest.
Thank you very much. So, thank you. They're already telling me, thanks for selling it, Cavuto. Yeah. But one of the things I think of, when interest rates back up, you know, I know people panic about this, but if you are a saver, or if you're depending on a CD, or your Social Security and the increases are pegged to those rates, you want interest rates to be higher than they are. How does that play out when you get close to retirement? They're reflecting an improving economy. That's why they're rising. But how is this playing out here? How high is high? What's the effect on people who worry about their stock investment?
Yeah, in all seriousness, this is a very serious issue for savers who have been miserable for a decade now with such low interest rates. So it's a double-edged sword. On the one hand, of course, you want more income, but the process of getting there is very painful if you're a bondholder. And a lot of people probably don't understand this dynamic. When yields go up, when the income from a bond goes up, the value of that bond goes down.
That's right.
The reason is because who wants to buy your 3% bond if there's a 4% bond out there? So the 3% bond is worth less. So the only thing that savers can do, in my mind, is to look forward and think, well, if this keeps on going, I don't want to own those bonds that are going to get cheaper. So a cool thing right now is the fact that
it feeds on itself.
Exactly, yeah. But you can get a 2-year bond, and this is a great thing. I mean, it's best in 10 years. A 2-year bond now has a decent yield of over 2%. And so that is a good place to be.
By the way, there's a crunching between the 2 and the 10-year, which sometimes presages, not all the time, a slowdown or worse, a recession.
If it goes negative, right? So if the 2-year bond is yielding more than the 10-year, then that is almost a foolproof sign of recession. So everyone's watching this really carefully, but the other signs of recession just aren't there, right? Unemployment is very low. We're seeing nice earnings growth. So it's a little bit of a mixed signal. It could reflect the fact that this earnings jump is not sustainable. Right, we've had this tax cut, we've had less regulation.
That's why we're seeing these 20 to 30% year-over-year returns. I mean, eventually you're going to be comparing to like periods.
Exactly,
right?
exactly. Yeah. So Credit Suisse says that 7% of the expected 18% jump in earnings this quarter is about the reduced taxes. And then energy, of course, is skyrocketing. Energy earnings are far and away the biggest component of this, up 79% estimated.
Well, not today. Not today. Yeah. I know the president did that. But a lot of people ask this, especially when you're getting close to retirement, some of the issues we're talking about here, that you're supposed to get very, very conservative. You pointed out in your fine book here, the older you are, that people are these targeted funds, that you're supposed to have less in stocks, more in bonds or cash, what have you. So people now on the verge of retiring or within the next few years, they're looking at this interest rate back up and they're thinking, gee, stocks have had a great run, a nearly decade-long bull market run. You know, 3% return on a 10-year note or close to it might not be great, but it's backed by Uncle Sam, and I don't know about stocks anymore. So what do you tell them?
Sure. First of all, don't buy the 10-year, buy the 2-year. because you get almost as good a yield. But if yields are much higher in 2 years, you can trade it in and get a higher bond.
By the way, that doesn't always apply to CDs, though, right? If you want a 1 year or 2 year CD, you're actually better off going a little longer term for the extra, right?
Well,
depending.
This is a case where you have to read the fine print. If you're allowed to cash that in with a small penalty, which some allow you to do, then yeah, go for the long one. If interest rates back up, sell it, pay a month or two.
But you do see rates backing up.
That's a good question. They may not. If, in fact, this is the high point for earnings. Mario Draghi said this morning, it's part of the reason I think the market is down, that this may be peak European earnings. You know, if growth doesn't skyrocket from here, maybe 3 or 3 something is the ceiling. So what do you have to do?
What if we have the best of both worlds, though, and we're missing that? We have stocks which are fine, not maybe too crazily valued, and interest rates, not older than you, as I said, I can remember them being a hell of a lot higher. It's just different from what we're used to, but it's not that bad.
No, I think there are a lot of forces that will keep a lid on interest rates, and it's not that bad, but you do need to, first to your question, even if you're on the verge of retirement, you want some stocks. I mean, if you're 60, your life expectancy is somewhere north of 90. That's a long horizon. You don't want to just sit in 2%.
Let me write that again. If you're 60 or close to it.
You or your spouse will live past 90.
Wow.
According to statistics. So therefore, you definitely want some stocks to get that growth. You're going to live through multiple bull and bear cycles.
Right.
But also make sure you diversify overseas. Those stocks are cheaper. And you might want to think about getting income from things other than bonds because of the possibility. I'm not saying it's going to happen. We don't know. But if they do go up a lot in price, then you're going to get hurt. So you might want some floating rate securities, which are available in ETFs and mutual funds. And that way, as rates go up,
but you get panned ETFs for the most part in your fine book some years ago.
Well, I didn't really pan them. What I said was that people were buying them just because they were the shiny new thing.
They're a recent phenomenon.
Yeah, and they're not necessarily better just because they're new. In a lot of ways, they are very good, but you pay a fee each time you buy and sell many of them.
The bottom line in retirement, to your point, it's no matter how rich you are, it's what you spend, what you take in.
Well, of course.
And that's what you got to adjust to.
Yes.
That reality.
Yeah. In other words, spend less than you're taking in.
Oh, now you tell me. All right. Thank you.
You've got time now.
Yeah, I got time. So you notice how he just routinely mentions these examples that hit home. All right. Jack Otter and I will continue doing this. So I know all you young people watching right now, you kids better listen. But we only have to get out with this in English, and Jack's very, very good at that.